In this video, we will delve into the crucial steps to kickstart your investment journey in the stock market, designed especially for beginners. The primary goal of investing is to build a portfolio that can ultimately support your financial requirements, enabling you to reap the rewards of your investments. The basics of investing start with understanding different asset classes, such as stocks, bonds, mutual funds, and real estate, each offering varying levels of risk and return. Unlocking the potential of passive income. Investing in stocks presents an enticing opportunity, particularly because of the benefits of passive income. Unlike traditional jobs, where individuals exchange their time and effort for a salary, stock investments allow for earning money without the need for continuous labor. When we discuss stocks, we are referring to a particular type of security that represents a share of ownership in a company. To clarify, let's take a familiar example: owning shares in Coca-Cola. By buying these shares, you effectively become a small stakeholder in the Coca-Cola Corporation, possessing a portion of the company's value and potential profits. So, in order to buy a stock, you need to choose a brokerage service. The first step in your investment journey is to select a brokerage firm. This is essentially a platform that facilitates the buying and selling of stocks. Fortunately, we are no longer in the era of relying on traditional brokers. Today, there are numerous online options that allow for a seamless trading experience. When selecting a brokerage, consider opting for a well-established firm that has a solid reputation in the industry. If you are a beginner looking for budget-friendly options, platforms like Robinhood and Webull have gained popularity for offering commission-free trading, making them ideal for novice investors. Investing can be a fulfilling journey, but it's vital to proceed with care and informed insight. Many beginners fall into the trap of making impulsive decisions, motivated by greed instead of a solid plan, which can result in significant losses. To keep yourself on the right path, it's important to create a clear investment strategy and thoughtfully choose stocks that reflect your objectives. Here, we'll explore 4 distinct investment styles, each with its own advantages and disadvantages. By understanding these approaches, you can choose the one that best fits your financial situation and aspirations. Exploring different investment strategies. Dividend investing. This approach is excellent for generating passive and reliable income. Value investing. Inspired by Warren Buffett, one of the wealthiest individuals in the world, this strategy focuses on identifying undervalued stocks. Growth investing. This is the investment style that Cathie Wood has recently leveraged to achieve significant profits. Passive index fund investing. A more relaxed investment approach that tends to perform well over the long term. Let's begin with dividend investing. This strategy allows you to enjoy a reliable source of passive income through quarterly or monthly dividends. Dividend investing is a style of investing where you purchase stocks that distribute a portion of their earnings as dividends. These payments typically occur quarterly, every 3 months, although some stocks may pay dividends monthly or semi-annually. By selecting strong dividend stocks, you can create a steady stream of passive income that flows into your bank account throughout the year. However, it's essential to approach this wisely. You can't simply grab a piece of paper and choose stocks based solely on the highest dividends. This method is too risky. We must delve into the numbers behind each stock. Here are some key points to consider. 4 key factors to consider when selecting dividend stocks. Here are 4 essential elements to keep in mind when evaluating dividend stocks. Let's use Coca-Cola stock as our example. This section will provide us with essential details regarding Coca-Cola's dividends. One of the first figures we should examine is the dividend itself. As seen here, Coca-Cola has a dividend of $2.04, resulting in a dividend yield of 2.83%. To put this into perspective, if we invest $1,000 in Coca-Cola stock, we will receive $28 annually in dividends. This yield is quite appealing, especially when compared to the market average of 1.278%. It's always beneficial to benchmark against market averages or competitors to assess the value of a stock's metrics. This approach helps you gauge the attractiveness of a stock's performance. Now let's examine the payout ratio. This ratio indicates the portion of a company's earnings that is distributed as dividends, as well as how much is reinvested back into the business. For instance, if a stock earns $20 per share and has a payout ratio of 40%, this means the company would distribute $8 as a dividend while reinvesting $12 into the business. Currently, Coca-Cola boasts a payout ratio of 78%. This figure reveals that most of their earnings are allocated to shareholders in the form of dividends, with the remaining 22% reinvested into the company. To be candid, this payout ratio is quite high. The underlying reason is that Coca-Cola is a well-established enterprise, operating more like a cash cow than a company focused on growth. However, I generally prefer to see a payout ratio significantly below 80%. It's always advantageous for a company to reinvest in its future growth rather than distributing all its profits as dividends. To start building your investment portfolio, here are some notable dividend stocks to explore. 3M Company. Ticker symbol MMM, dividend yield 1.94%, a strong player in the consumer goods sector offering a solid dividend. Johnson & Johnson, ticker symbol JNJ, dividend yield 3.37%. This stock represents a reliable option in the healthcare sector. AT&T, ticker symbol T, dividend yield 4.20%. While riskier, this stock provides a significantly higher dividend yield. The passive income generated from dividends is quite dependable. This reliability is particularly true if you invest in robust business models. Additionally, you can benefit from capital gains on the stock, providing you with two sources of income. However, one downside to dividend investing is that these companies tend to be more established and may offer less potential for rapid growth compared to other investment styles. Nonetheless, this approach is generally considered a safer and more reliable form of investing. Now, let's shift our focus to the investment style that propelled Warren Buffett to billionaire status: value investing. While I'm not claiming it will make you a billionaire, after all, we're not all Warren Buffett, value investing can yield substantial returns if approached correctly. The core principle of value investing. The essence of value investing lies in acquiring stocks at prices lower than their true worth. Essentially, it's akin to bargain hunting. However, instead of visiting garage sales or retail stores, you explore the stock market. Now, the question arises, how can we determine if a stock is truly inexpensive? Should we merely observe the price and assume that a 30% drop makes it a bargain? Unfortunately, it is not that straightforward. Often, when the price decreases, the overall value of the business tends to decline as well. The essence of value investing. The fundamental principle of value investing lies in assessing the intrinsic value of a business. Once you have established this value, you can easily compare it to the market price to determine whether you're securing a great deal or potentially being taken advantage of. 3 fundamental principles of value investing. 1. Identify the current cash flow. 2. Determine the growth rate. 3. Calculate the terminal value. Once you understand the process, you begin by analyzing various stocks. Focus on comparing the price to the value. This is crucial. This approach is reminiscent of what Warren Buffett did in his early years. In a time without the internet, he relied on Moody's manual. He mentioned that he went through the entire book twice, examining different businesses in search of bargains. There are plenty of stocks in the market, and one effective method to identify value stocks is by examining their P/E ratios. Understanding the P/E ratio. This stands for price-to-earnings ratio, which essentially compares a stock's price to its earnings. A low P/E ratio indicates that the stock price is relatively inexpensive compared to its earnings. Conversely, A high PE ratio suggests that the stock price is relatively expensive compared to the earnings it generates. Finding the PE ratio for stocks is quite straightforward. It's quite simple to find the PE ratio for stocks. Just head over to our trusty friend, Yahoo Finance. Navigate to the summary section, and you'll see it listed right here. Coca-Cola has a PE ratio of 28.77. This indicates that the price is 28 times greater than the annual earnings, which means it would take approximately 28 years to recoup our investment if earnings remain constant. Now, you may wonder whether a PE ratio of 28.77 is considered high or low. One way to determine this is by comparing it to the market's average PE ratio, which currently sits at approximately 28.65. This means that Coca-Cola's PE ratio is quite close to the market average. It's neither significantly cheaper nor more expensive. Thus, Coca-Cola is primarily seen as a dividend investment rather than a value investment. Here are several noteworthy stocks that have attracted the interest of value investors. Alibaba. This Chinese e-commerce powerhouse has garnered attention from value investors, particularly following its recent drop in stock price. Although it's a somewhat contentious choice, prominent investors like Charlie Munger and Ray Dalio have included this stock in their portfolios. Berkshire Hathaway. Rather than being a single stock, this represents a collection of value stocks, as Warren Buffett oversees this investment firm, which holds numerous companies. GameStop. Once recognized as a significant value opportunity, especially a year ago, before the infamous Reddit versus hedge fund saga unfolded. Bank stocks. Currently, bank stocks present an attractive option for value investors, mainly due to their low PE ratios. Warren Buffett has made considerable investments in this sector in recent years. While I'm not advising you to rush into buying these stocks, they provide a solid foundation for anyone exploring value investments. Growth investing, embracing opportunity and risk. This investment style carries more risk, especially in the event of a recession, where you may face significant losses. However, it also offers the potential for rapid, high returns. Consider the example of Cathie Wood, who has embraced innovation and growth as her primary investment strategy. Over a span of 7 years, her innovation fund has averaged an impressive annual return of 39%, which is more than 3 times the return of the S&P 500. Key considerations for growth investing. If executed wisely, growth investing can yield substantial rewards. Here are a few crucial points to focus on. Future direction of the business. Assess where the business is headed. What does the future hold for the business? Is it innovative? Is it disruptive? Is it poised to become the next Tesla, transforming the automotive industry? Alternatively, will it become obsolete like the textile industry in the 1970s or the video rental and newspaper sectors in the 2000s, which were overtaken by innovation? So, put on your thinking cap and consider what will be the next disruptive force. Over the next 5 to 10 years, certain industries are poised for significant growth. Examples of thriving sectors include artificial intelligence, automation robotics, self-driving cars, think Elon Musk, blockchain technologies. These areas have the potential to transform business operations in the future, and many investors are particularly focused on these sectors. However, it is essential to conduct thorough research into their financials. There's little value in acquiring a business that may be popular but fails to generate profit. When it comes to growth investing, revenue is a crucial metric to examine. Revenue represents the total income generated by the business, and it is vital to ensure that this figure is on the rise. Take Tesla, for example. One of the most popular stocks is showing significant growth. According to Yahoo Finance, it consistently generates increasing revenue each year. Now, let's shift our focus to the other important aspect, return on equity, ROE. This metric provides valuable insight into the business's effectiveness from a financial perspective. Return on equity is calculated by dividing net income by shareholders' equity. This calculation reveals the profit we can generate as a percentage of equity. Ideally, we want this figure to be as high as possible. We can determine the return on equity by simply navigating to the statistics section on Yahoo Finance. If we scroll down a bit, we find that Tesla's return on equity stands at 8.77%. This figure is quite respectable, especially when we compare it to their competitors, which I will demonstrate shortly. Just above that, we can also look at profit margins, another important metric that helps us gauge the business's effectiveness. As shown, Tesla's profit margin is 6.38%. This means that for every $100 in revenue Tesla generates, $6.38 will be profit. While it can be challenging to assess whether these numbers are favorable, it's essential to compare them against other companies to better understand their significance. So let's delve into Tesla's performance in relation to its peers. So, Tesla's competitors, which include Rivian, which have a negative profit margin, 76.83%, and a negative return on equity, 53.72%. Ford, which has a profit margin of 2.74% and a return on equity 11.150%. Volkswagen has a profit margin of 3.04% and a return on equity 5.51%. And Lucid has a minus profit margin of 275% and a minus return on equity 50%. Tesla truly outshines all its competitors when it comes to these two metrics. Elon Musk is undoubtedly an exceptionally intelligent individual. We can confidently say that. Another tactic that many growth investors often employ, though it's not one I personally favor, is analyzing a stock's historical price to determine if it shows an upward trend. It's quite straightforward to observe this trend. Simply type Tesla stock into Google, select the 5-year view, and you'll notice a consistent upward trajectory each year. While this doesn't guarantee that the stock will continue to rise in the future, many investors appreciate that positive momentum. Here are a few examples of growth. Coinbase. This cryptocurrency exchange platform is a great option if you're looking to delve into the blockchain sector without purchasing individual cryptocurrencies. Intellia Therapeutics. An exciting company focused on genome editing, aiming to develop cures for various diseases. Palantir, a software company that integrates data to enhance business decision-making. Founded by Peter Thiel, who co-founded PayPal and was the first external investor in Facebook, this company has a strong track record. And then there's Tesla, the electric car manufacturer, which is classified as a growth stock. However, with a market capitalization of $1.1 trillion, its potential for significant growth is diminished. It's advisable to avoid purchasing stocks once they become overly hyped and are already gaining traction. Instead, look for opportunities when they're discussed on smaller platforms, such as Reddit forums or specific Discord groups. This is typically the ideal time to invest, rather than when major media outlets are highlighting them. By buying in at an earlier stage, you position yourself for substantial returns, potentially achieving gains of 10, 20, or even 100 times your investment. Passive investing in an index fund is a great choice for those who prefer not to spend time researching and analyzing various stocks. Interestingly, index investing often outperforms most other investment returns. It actually beats most other returns that big hedge funds get. It sounds untrue, but it is actually true. So this is why you have people like Warren Buffett recommending it to most investors. An index fund is essentially a collection of stocks designed to track a specific segment of the market. For instance, the S&P 500 index fund consists of 500 large companies that reflect the performance of the American stock market. Similarly, the Vanguard Information Technology Fund includes over 300 U.S. technology stocks, focusing on the tech sector. Additionally, the Vanguard Dividend Appreciation Fund monitors 247 companies that have consistently increased their dividends over time. This shows that you can invest in index funds, which are groups of stocks that cover various areas of the market based on your investment preferences. It may seem unusual or almost too straightforward, leading one to wonder, what's the catch? However, in the realm of investing, sometimes less truly is more. I would suggest that among the various investment options available, a very low-cost index fund is a great choice. Rather than investing all your money at once, consider accumulating shares in a low-cost index fund over a span of 10 years, with consistent contributions. I believe this strategy will likely outperform the investments of around 90% of those who start investing at a similar time. To purchase an index fund, all you need to do is enter the ticker symbol of the fund you wish to invest in through your brokerage account. This could be a world market index fund, a real estate fund, or one focused on healthcare. Consider the market sectors you want to invest in and proceed from there. It's crucial not to linger for too long. Do your preliminary research, ensure you grasp the fundamentals. However, you don't need to be Warren Buffett before you begin investing. Take the first step by investing. Start small by purchasing your first stock. Remember, stocks can be quite affordable. Ford is around $10, Apple is about $198, and Coca-Cola is priced at $71. Begin with a modest investment. Learn as you progress. The worst thing you can do is delay, lose your motivation to invest, and ultimately refrain from investing altogether. One question we might consider is, have you noticed how high stock market prices are currently? We have been experiencing a 10-year bull market with prices consistently rising. Should we adopt any strategies in response to this? Is a crash on the horizon? When it comes to investing, we need to adopt a long-term perspective. This is a lesson I learned from Warren Buffett. We should consider whether the market will be higher or lower in 5 or 10 years. My belief is that it will be higher as stocks, essentially businesses, continue to generate earnings and grow. Even if we invest now and, heaven forbid, a market crash occurs, remember that the market will eventually rebound. The key is to stay calm and avoid panicking when prices drop. Instead, we should follow Buffett's approach. When the market crashes, buy more stocks. This is when stocks are available at lower prices, presenting greater profit potential. Additionally, if you invest in high-quality stocks that generate income, provide value to their customers, and innovate, you'll still see returns even during market dips. With smart investing strategies, there's no need to fear a market crash. Choose your investing style. Wisely decide on the investing style you wish to adopt moving forward. Take the time to learn as much as you can about that particular style, but also explore all investing styles and gather insights from each. Begin by cautiously investing in a few stocks. Don't be afraid to make mistakes as they are part of the learning process. Gradually, you will start to master the art of investing, and eventually, your portfolio may even allow you to retire comfortably. Best of luck on your stock market journey.